My dear students, today we are going to do a practical problem from the module Capital Gain. In order to compute long-term capital gain, what we have to do is from full value of consideration, that is sales price, deduct selling expenses. Now we will be getting net consideration. From that, deduct indexed cost of acquisition and indexed cost of improvement. Then we will be getting long-term capital gain. You have to remind certain points while calculating long-term capital gain. Point number 1. Indexation is not possible in case of short-term capital assets. Depreciable assets are considered like short-term capital assets. So, it is not indexed. Point number 2. In case of assets acquired before 1/4/2001, the cost of acquisition of asset shall be allowed to be taken as fair market value on 1st April 2001 or actual cost as chosen by taxpayer. Usually that may be fair market value or cost of acquisition, whichever is higher. Then that opted figure can be indexed. Point number 3. Indexation means adjustment in the cost of capital asset based on cost inflation index. At present, base year is fixed at 2001 and cost inflation index for base year starts at 100. Point number 4. Any cost of improvement before 1/4/2001 is not considered to determine long-term capital gain. So, it cannot be deducted. Point number 5. Long-term capital loss can be set off against long-term capital gain only. Point number 6. Capital gain on personal assets like car, furniture, etc. are not taxable. Okay, now let us read the question. Mr. Anil bought a house property on June 2002 for rupees 5 lakh and during March 2012 he spent rupees 7 lakh for additions to the building. Sold it on February 2020 for rupees 60 lakh. He also incurred selling expenses rupees 50,000. Compute capital gain. Cost inflation indexes are also given. 2002-2003 it is 105, 2011-12 184, 2019-20 289. Now let us start doing the problem. So first step is we have to write full value of consideration. Full value of consideration means it is sales price. In the question, it is given that sold it on February 2020 for rupees 60 lakh. So, full value of consideration is rupees 60 lakh. We can write full value of consideration rupees 60,000. From that, we have to deduct selling expenses. Selling expense is rupees 50,000. So, deduct 50,000 from 60 lakh. We are getting 59 lakh 50,000, that is net consideration. From net consideration, we have to deduct indexed cost of acquisition and indexed cost of improvement. Remember that while computing long-term capital gain, we have to do indexation. Indexation is the process of estimating the present value of transferred asset on the basis of cost inflation index. So write working note indexed cost of acquisition. Formula of indexed cost of acquisition is cost of acquisition into cost inflation index at the time of sale or exchange divided by cost inflation index at the time of purchase. Cost of acquisition, that means purchase price. Purchase price is rupees 5 lakh. So 5 lakh into cost inflation index at the time of sale. 2019-20 cost inflation index is 289. So into 289 divided by cost inflation index at the time of purchase. So here it is stated that he bought house property on June 2002. So we have to consider cost inflation index of 2002-2003, that is 105 divided by 105. We are getting 13,76,190.476. We can round off this to 13,76,191. We can deduct this figure from net consideration. Right here, less indexed cost of acquisition, 13,76,191. Again, we have to deduct if there is indexed cost of improvement. So when we read the question, we can understand that during March 2012, he spent rupees 7 lakh for additions to building. So there is cost of improvement. Again, we have to calculate indexed cost of improvement. Write this as working note. Formula for finding indexed cost of improvement is cost of improvement into cost inflation index at the time of sale divided by cost inflation index at the time of improvement. So cost of improvement is 7 lakh. 7 lakh into cost inflation index at the time of sale, that is 289, divided by cost inflation index at the time of improvement, that is 2011-12, it is 184, divided by 184. We are getting 10,99,456.5217. We can round off this to 10,99,457. Deduct this figure from net consideration. Right here, less indexed cost of improvement, 10,99,457. When we deduct these figures from 59,50,000, we are getting 34,74,352. This is long-term capital gain. Okay, hope you understood this problem. Thank you.